I think the age of funds being asset aggregators and sort of hoovering up as much fund as they can, just for the sake of it, as part of their, to try and grow profitability. I mean, those days are over. I mean, you really need to outperform consistently to have a viable through the cycle business, and that we apply that requirement across all of our products.
Hello and welcome to Assay TV. Today I'm talking with Sam Berridge, who is Portfolio Manager for the Perennial Global Resources Trust. Sam launched this new fund in April, slightly fortuitously possibly, avoiding the COVID sell-offs of February, March. But Sam, you've had a fantastic performance to date. I think up almost 50% in its maiden quarter.
Yeah, that's right, Leo. I think it was definitely a bit of good fortune in terms of timing, albeit this was a product that we've been working on in the background. I mean, it does take a little while to get the ducks in a row to launch this thing, and certainly the commodity or the broader commodity space had been very much unloved for a long period of time, and we saw an opportunity there to take my expertise, which I'd been a portfolio manager within the microcaps trust for 4 years, and part of my responsibilities there were the commodity space, was to sort of take that and apply it in its own right to a global resources trust, and hopefully try and exploit some of the opportunities therein.
What did you see in the market which made you think this was the time to launch a mining fund?
I think it was. I mean, Perennial is a value house, and always has been. So, we're naturally contrarian investors, and when we look at a sector which has been so desperately unloved for such a long period of time, and not only in an absolute sense, but also in a relative sense. So, you plot the various commodity indices versus the S&P 500. And they're at all-time lows, and this is going back over 50 years. So, it is a space that has been horrendously starved of capital, and as a result of that, investment expertise has been leaving the sector, both on the buy side and on the sell side, and so that leads to market inefficiencies, and pretty much every fund, whatever its speciality. I mean, all you're doing is exploiting market inefficiencies, and so we saw one, and this was a space which is very near and dear to my heart. I've been operating within it as a geologist, and then as an analyst, and then as an investment professional for 15 years, and had a reasonable investment track record there. So it made sense to dive in and try and exploit some of those inefficiencies.
Now, what are your current assets under management, and what are you targeting?
Well, at the moment, it's probably just the seed investors in the fund. So we've got circa $10 million under management at the moment. Albeit that's grown sort of organically and inorganically since we kicked off over the last couple of months. What we're aspiring to, I mean, we've got a figure of 500 million out there, but we'll see how we go. I mean, I think the age of funds being asset aggregators and sort of hoovering up as much fund as they can, just for the sake of it, as part of their, to try and grow profitability. I mean, those days are over. I mean, you really need to outperform consistently to have a viable through the cycle business, and that we apply that requirement across all of our products. So we'll see how we go, and as long as we can move capital into and out of the market without too much friction, then we'll allow the fund to grow. But as soon as we feel there's undue impact on performance, we'll shut the doors. We'll shut the doors and leave the fund at that.
And how many stocks do you currently have in your portfolio, and which way are they weighted towards which commodities?
So there'd be 37 in the portfolio at the moment. There's a skew towards gold and mining services, gold you'd probably expect, but certainly and ballpark is probably 18 to 20% weight in gold, roughly 20% towards mining services as well, which We do get some questions on that as to why, as a commodity fund, do you include the commodity services in that space? And it goes to the point of setting the fund up in the first place. It's to make money, and we make money out of inefficiencies. And being that I visit as many mine sites as I do, I've averaged sort of one every 2 weeks for the last 4 or 5 years or so. Obviously outside of the COVID period that we are in at the moment. But, you go and see the mine, but while you go and visit the mine, you go and see the mining contractors are there, you speak to the service providers, you get some feedback from the miners as to who's doing a good job, who's not. You get probably an earlier look at expansion plans and volumes, which may then apply to, the earth mover or the drilling company or whoever may be on site. Also, there's a great deal of mining tech, which has really emerged as a sector in its own right, probably since 2016. You get an early look at that as well. But then, aside from mining services, we've got a sprinkling of exposures across a nickel, a little bit of metallurgical coal. And just dipping the toe in the water on a bit of lithium at the moment as well.
And which have been the best performance so far?
Well, coming out of COVID, the whole market rallied pretty sharply. So certainly the gold stocks have performed very well, and sort of gone on with the gains that they showed throughout the June quarter. One sector which popped quite hard but then has sort of stagnated is the mining services space, and that's consistent with our weighting there. A lot of these companies are reporting or guiding to earnings which are very much in line with what they were saying back in January before this COVID pandemic kicked off. And yet share prices are as much as 50% below where they were for the same earnings 5 or 6 months ago. So we certainly see that as an opportunity, and it has been a good area of success for the June quarter, and we'd expect it to do pretty well throughout the September quarter, particularly into reporting season.
Well, there seems to be an awful lot of activity going on despite the COVID, crisis, particularly in the drilling space. Companies announcing drill hole results every day, it seems.
Yeah, that's 100% correct, and it's amazing. Like, there's all this money being raised. A lot of it's going into the junior explorers. That money is going straight into the ground, and that's via the drill bit. And yet, you look at the drilling companies who are doing all the work, and they're still priced as though there's they come downgrade. I think it's the exact opposite here. The outlook for exploration, drilling rates is remarkably bullish. And there's anecdotal evidence of that through from the mining companies themselves in the labs, which they were achieving sort of circa 2 to 3 weeks turnaround for their assays for their samples 3 or 4 months ago, but that's pushing out to 3, 4, and 5 weeks at the moment. So that's indicative of elevated levels of activity in the drilling and exploration space.
Absolutely. And what sort of companies, what size of companies do you typically invest in? Are you looking at explorers, or are you looking at, the larger companies?
We have a pretty broad spectrum, but we, as a general rule, we won't touch the greenfield, the greenfields exploration companies, and that comes from my background in geology. I worked as a geologist for about 6 years, and I know that you can have the best target or geological target you could imagine. You can have the geochemistry, you can have the geophysics, you can have even some early stage drilling above it, all lined up on a nice structure, and you think, this is an absolute sure thing. And then you go and drill it, and 50% of the time there'll be nothing there. So that sort of binary outcome is of no interest to us. We don't go that far down the spectrum. However, where we've had some great success is just above that. Quite often you get situations where an existing resource sits within a larger company, is deemed to be non-core and flicked out into a much smaller company, and that's a situation where from our point of view, there is very limited exploration risk. I mean, these resources might have, 300 or 400 drill holes through them already. So there's no exploration risk there. But the asset, you assess it on its merits, and quite often it's mispriced. So, that's probably as far down the spectrum as we go. And then on the upside, I mean, the existing producers and the larger mining services companies. If there's opportunities to, where companies are mispriced, or there's a catalyst that we foresee that, which might, lead to a bit of outperformance, then we'll certainly get involved in some of those larger ones as well.
And do you have any thoughts on the gold price at the moment? I think it's today it's about $1950 US. That's about 2,700 or so Australian dollars. Still higher, going higher, or what's your take on that?
I think in the medium term, it's going higher. I mean, we've only just passed the all-time highs of 2011, and if my opinion of if you have a look at the structural reasons why the gold price has been on a tear for the last year and a half or so, I don't think those reasons are going to be resolved in the next 6 months. So even though we've had a very sharp run from $1,800 up to $1,900 an ounce, and then beyond that, and the gold price is probably due for a little bit of consolidation, or perhaps a small pullback from where it is at the moment. But medium term, I mean, the outlook for real rates, is negative, and looks like staying negative for a while. How the various governments around the world end up tackling the huge amounts of debt they're racking up in response to this COVID pandemic, that remains an unknown. So until all those questions are answered, I think gold's likely to grind higher.
With gold prices this high, though, is there a risk of there being a bit of a bull market in gold, and some froth being introduced into the market?
Oh, certainly. I mean, it's amazing how many newspapers and whatnot are now sticking gold on the front of their finance section. All of us over the last month or so, whereas usually it never cops a mention, and that's indicative of a market that's perhaps getting a little bit ahead of itself. And certainly from the capital raisings and the deals that passed my desk. I mean, the quality of some of these assets and businesses is certainly declining as we're getting, more and more, genuine greenfield explorers trying to raise money at elevated valuations, which I think is, it represents quite a deal of risk to the investor, because, the last thing you want as an investor in the gold space is getting your call on the metal correct, and then having, taking on too much risk via your equity exposure to that metal price, and then having it blow up. And then, instead of making money out of a rising gold price, you end up losing money. I mean, that's a risk that I think is, people perhaps lose sight of in a very sort of red hot market, but it's something that we're very cognizant of. And very sort of wary not to get too caught up in the excitement of these, often one drill hole wonders.
So still need disciplined stock selection.
Oh yeah, definitely. I mean, you sit as an investor in the mining space. You do, whether you avoid it or not, you're going to end up pretty skeptical after any extended period of time, and that skepticism is hard earned. So. You see the cycles come and go, and we I suppose it's always, you sort of with you see these companies going up sort of 100% on a good drill hit, but in reality, trying to predict those things is very, very difficult to do, and it's almost casino-like. So for us, those opportunities are never there. We go look at the resources, and if we can get a free option on that exploration upside, I mean, that's the sweet spot for us. It's something we won't pay for, but if you can get an option on it, then great.
But there must be producers at the moment who are making some good margins.
Oh, certainly, and I think they are making good margins, but you sort of always need to balance the expectation versus what the company is going to deliver. I mean, just through this quarterly reporting season, we've seen a few examples of where gold companies have run up, quite strongly on a rising gold price, but then you get to the quarterly report and the production or the guidance for FY21 isn't quite what the market expected, and the companies have been sold off as a result. So you need to keep in mind balance, like what the market's expecting versus the absolute achievements of the gold company itself, which in almost all cases are up strongly year on year.
Are you expecting cost inflation to take place? Because typically when the gold price gets high, the costs go up as well. What's happening on that side?
Yeah, that's a fair point, and I think there's a lot of skepticism from generalist investors, and I saw some comments this morning from one well-known investor highlighting exactly that point, that quite often through a commodity boom, the mining companies historically haven't been great at sort of maintaining their margins and harvesting that cash and ultimately returning it to investors. But to date, this cycle, as a sector, the gold companies have been very good at maintaining their costs, which have are creeping up a little bit, but by and large, could be described as flat. And margin expansion has definitely taken place, and I think it was BMO put together a great chart on that, and that margin expansion has been substantial. So it's as though the management teams, now in charge of the larger mid-cap producers, are very cognizant of some of the hard lessons learned from the last commodity price boom, in which there was a huge amount of capital torn up. I mean, costs almost increased lockstep with the actual commodity price, so there was no margin expansion at all. And then when the tide turned, there was just a huge amount of value destruction. But to date, they've been pretty disciplined, both on the cost front and also on the M&A front as well. So that's why we haven't seen these overpriced takeovers like we thus far, or yet, I should say.
They've learned their lessons. Looking beyond gold, what other metals do you see holding promise at the moment?
I think coking coal is holding a lot of promise. I mean, that's been bumbling along at sort of circa $110, $107 a tonne at the moment. Capacity is being cut all over the place. It is a key requirement of steel production, and it's very rare to find new resources of it. It's getting harder and harder to even if you find those resources, to then develop them, because various countries are making it more difficult, I suppose, to develop these coking coal resources. I mean, and this is very distinct from thermal coal. So it's that's thermal coal is a different matter, but met coal is necessary. So we're right into the cost curve there, and I think as steel production around the world recovers with this stimulus package that's underway, we should see those prices start to recover. Beyond that, I mean, copper has run pretty hard. So from where we are at the moment, I think it's a bit difficult to get excited about. I mean, nickel, yes, is probably slightly more positive on that one, but I'm just a little bit mindful that there is quite a few years between the dominant use for nickel now, which is stainless steel, sort of being taken over or transitioning to this forecast battery demand. So I think that people are perhaps assuming that this battery demand for nickel is going to kick in a little bit earlier than what it perhaps will. But probably last worth touching on. I mean, lithium, which was these are quite a few equity exposures to that. It's prices have been falling for a year and a half now, and are well and truly into the cost curve, and their production is being cut left, right, and centre, and the market is well and truly through the rebalancing phase. I think that's an area which looks interesting, and the equities starting to anticipate a little bit of a price recovery, but still probably present some opportunities there.
Well, it's certainly been an unloved sector for the past year or so, but with one would think a big potential in the future.
Oh, yeah, yes, definitely. I mean, it's you look at the number of different companies and different models that are bringing releasing their new electronic sort of vehicle range to market. I think the stimulus measures as they rack up are going to be targeted towards increasing electric vehicle sales. So, there's going to be a few tailwinds behind the space, and the cost of these cars keeps on coming down. So yeah, I mean, you can see the upside there, but I think in the short term, I think that perhaps the market tightens up again and the prices pop. But I think what people need to keep in mind longer term is whilst there is a sort of a huge projected demand for lithium, like the mining industry is very, very good at ramping up when it needs to. And I mean, we saw that with the last lithium cycle. There was a huge increase of production outside of or just out from Australia, in a very short space of time. So, I think there's plenty of lithium to go around, but the mining companies might take 12 or 18 months to get their act together once the price incentivizes them to do so. But I'm quite confident that over the longer term that demand will be met.
So, if you are a mining company out there and you're looking to approach Perennial and like to pitch, what do you look for in a company to potentially add to your portfolio?
I suppose depending on what stage of life this company is at. As I mentioned, I mean, we have a value bias. So, I think a company has to have a decent, tangible asset to speak to. If they're selling a dream or a concept, then that's not for us. But as far as the producers are concerned, I mean, we look at them through the lens of the same way that you'd value any other company, whether it be price to earnings, price to free cash flow, or EV to EBITDA, or what have you. But over and above that, you have to have a slightly different value methodology to assess companies which have depleting resources, and so we model full life mine net present value or cash flow forecast with a net present value, and compare that to the value the valuation that's currently sitting with the company, and and have a look at the pros and cons, and where the upside is from the business versus what price you have to pay to get exposure to it. And then, if you want to talk to, if you speaking to the mining services space, then, you use traditional, industrial valuation. We use traditional industrial valuation metrics to assess the value there. If there's core IP, record of decent cash generation, and for whatever reason they've fallen on hard times or are just a little bit unloved, then certainly that's a space that we are interested in and we invest in frequently.
Fantastic. Well, that's been a very interesting insight there into the Perennial Global Resources Trust. Thank you very much for joining us today, Sam.
Thank you very much, Leo. It's been a pleasure.
Thanks.